Hello, everybody. Frank Dippold here from Velocity of Money and Velocity Money University. Last 2 weeks, I had Thomas Massera and Brett Sikora on, and this week I'm doing it solo. I'm excited to share some information with you guys today. We're going to talk about a couple things. We're going to talk about mindset first. Then we're going to talk about what's going on in the bond market with interest rates because they've gone up a bit. But there's also some wacky stuff that have gone on with investor loans and second homes. I'm going to explain that. And we're going to talk about buying power. We're also going to talk about the upcoming seminar tomorrow for our coaching clients, Blueprint to Become Real Estate Millionaire. So let's get rocking and rolling. I got a fancy new screen today, so I'm looking at myself as I speak, which is very awkward, but that's okay because I know maybe Facebook makes me look better. I have no idea. So anyway, let's get rocking and rolling. Let's talk about mindset for a minute. A lot of people come to me and they're like, I have bad credit, or I don't have enough money to be a real estate investor. The first thing we have to do is we have to look at kind of where they're at. And what I always say to people that say I have bad credit is it's not that you have bad credit. It's that your habits for paying your bills is bad, or your habits have been a little sloppy. So what we need to do is retrain you in the thought process and first educate you about what it takes to have good credit. Do I, have an advantage if I pay on the 29th of the month versus the 1st or the 5th, or, people that try to float credit card to credit card because there's a 0% interest rate for the first 90 days. Those things usually don't work. And so the first thing I need to do is I need to create a new mindset for even the person who wants to buy their first property to live in with their family. Or maybe they're 26 years old, they've gone to college, they've borrowed money on student loans, and they're like, oh, well, they told me it could be deferred for 4 years. And I'm like, well, 4 years of deferment, if you owed $80,000, right? And deferment means that every single month, whatever your payment is, gets added to the balance. So you owe 80 today, 4 years later, you owe 110, and now you're paying back 110. So there's all sorts of things there from a mindset perspective. But let's talk about the real estate investor for a second. The real estate investor, early on, either bought properties and they went up in value, or got involved in a flip and they got kind of lucky because, flips are not so easy, especially now. But for some reason or another, they got involved in real estate. And I have a lot of friends that did wholesale. They did sheriff sale. They did probates. They did deed and liens, which I teach people at the university. But now they're having trouble finding inventory. And the mindset there was flip a property, make 20 grand. Wholesale a property, make 10 grand. And that's great, but that's like a day job, meaning what do you have now? And the real estate investor that understands the long-term buy and hold, which is what I show, understand that we're using the bank's money to buy the property, which is us, and you're using the tenant's money to pay off the property. So think about that. Like, let's start with this. If you're a first-time home buyer or you don't own any real estate right now, if I showed you how to buy $1 million worth of real estate for less than $40,000 out of pocket, now you buy $1 million, you owe $960, for example. But over a 30-year period, your tenants pay off that $960 to zero. Now, I'm actually going to show you how to pay it off in 15 or 20 years using the tenant's money and capture 50% of that yearly cash flow that you get. So who wouldn't want to buy $1 million worth of real estate, right? Yeah, you owe the money, but someone else is paying it off for you. And then in my coaching classes, I talk about with inflation and real estate growth, what the million in real estate will grow to in 18, 20, 30 years, and what the rents will grow to in 18, 20, 30 years. And then we create a mindset around who you become. Who will you be in 30 years? Who will you be in 20 years? I will guarantee one thing right now. If you follow my strategy and you come to the coaching classes, who you will be in 20 or 30 years because we showed you how to buy real estate, because we showed you how to be a real estate millionaire, will be drastically different than the path that you're on right now. So 99% of the people I talk to are like, I don't know where to get started. I'm like, I do. I know where to get you started. It begins with looking at your credit, your finances now, your job. The only person I can't help is the person that has no job, no money, and a 480 credit score. We need something, right? We need a job, because with a job, we can help you with a budget. With a budget, we can help you get your credit score up. We can potentially send you to a credit repair university type of thing. So we just need something to get started. And if you're not working now, doesn't mean don't feel bad about it. Be like, oh, Frank and his team can't help. No, we can help you with your mindset, which may help you get a job, which may help you excel in your job. And maybe you'll start thinking more like an entrepreneur and less like an employee. And we can help you with the mindset around what it takes to win. Because what's the difference between somebody who makes $1,000 a month, somebody who makes $10,000 a month, somebody who makes $100,000 a month, and someone who makes $1 million a month? Mindset. It starts with that. Now, if you believe you can make X, then there's a chance you might make X. My son was just telling me about a guy last night who's very wealthy, and he's doing this 90-day challenge. He's putting all his money away. He's not using any of his money to make money, and he's giving himself a goal of making $1 million in 90 days, right? So he theoretically lost all his resources, but he actually didn't lose all his resources, because the main resource is here in his mind, in his confidence and knowledge and ability to know that he can make the money back. So wherever you are today, doesn't matter. You're going to get in touch with us. You're going to come to tomorrow's seminar, which, by the way, is at noon tomorrow. We're going to put a link or an invite to the seminar. Jasmine will do it shortly. We'll also do it at the end. Come to the introduction. It's free. I give you a lot of information to get you to the next level in your life. Because guess what? I was 25 years old yesterday, and today I'm not 25 years old. You basically could double that, and guess what my age is, right? And I still look at the guy that played high school football and college baseball, professional baseball, and I'm like, I'm not that guy. Those days are over. That's in the past. But what I take from the past is things that made me successful. I don't live in the past. I don't say, oh, I screwed up in 05 and 06, and I went too heavy on properties in Colorado. I don't do that. But what I do take is the lesson and knowledge I learned from the mistakes I made. So, I've done over $1 billion in loans. I've done more than 35 properties myself. I've helped hundreds and hundreds of people buy real estate. So there's never been really a mortgage group and a real estate group that have meshed this way, right? So that's who I am. And we are, we earn a good living doing mortgages. We have a great organization. I love helping people, first-time home buyers, second homes. We love helping people. But what I like doing more is saying, you can be a real estate millionaire. We can give you the plan now, and then we can back into it with monthly, quarterly, yearly activities to get there. It's actually so simple that I want to scream from the rooftops. And you don't just have to be a first-time home buyer. You could own a home already with equity or not equity. You could have a little money in a 401k or IRA that I can use to parlay into real estate. Or you could be a real estate investor right now that maybe has a couple rental properties, and or maybe you did 5 flips or 10 flips. Doesn't matter where you are, because the real estate guys don't understand the lending world. And the lending guys who are just shucking interest rates, I'll give you 3%, whatever. They don't understand really the real estate investing world. And I've married the two. So let's parlay this into the conversation about interest rates. So for some of you that have never heard me speak, interest rates are derived from the bond market, right? There are such things called the mortgage-backed security pools. The mortgage-backed securities really are the buying and selling of the Fannie Mae, Freddie Mac, and Ginnie Mae paper. Those are the regulatory bodies in America that dictate the guidelines. And we, as a mortgage company, use Fannie, Freddie, and FHA guidelines. FHA and Ginnie Mae, by the way, are the same thing. And the bond market bids. So typically, there's 3 houses. There's, commodities, there's stocks, and there's bonds. Commodities are like silver and gold and all these other things, oil. And money typically sits in two of the three at a time. And typically, stocks and bonds kind of work in opposite directions. Not always, but most of the time. So what happens is if money is flowing into the stock market and out of the bond market, then what happens is the bond market is selling off and rates are going up. The opposite happens if people are buying bonds, right? And maybe they're leaving stocks and rates are going down. So recently rates have gone up. Now, we knew it was going to happen at some point. We knew that, the 2.5, 2.25, 2.75 rate was not going to be forever. And I find it so funny when our mortgage clients are like, 2.5. Could you get me an eighth better? I'm like, oh my Lord, like an eighth better, like you're 4.5. And yes, 2.5 is the bottom. And that's amazing. Like that's like buying an Apple stock for like $2, $4. So now they've gone up a little bit. Now, on owner-occupied properties, the rates are still tremendous. Let's talk about what happened with second home and investor. Fannie Mae came out and said to the investors, to the Fannie Mae direct lenders, we don't want our portfolio, we don't want your portfolio of investor loans or second home loans to be more than 7% of the total loans. So 93% have to be owner-occupied, and the rest can be second home investors. So what happened is the bond market freaked out last week. And if a lender who sells a lot of paper to the ticket window or the bond market had 6.5% of their loans already were investor or second home, then they would completely change their pricing so that the other lenders that sell to them don't want to sell to them because the pricing's so bad. So when investors leave the market, what happens is the pricing goes up because there's nobody that wants to buy that paper. So that's what happened with the investor loans and the second homes. There's also something called yield curve, which this is a little complicated. I'll keep it simple. The yield curve oftentimes becomes inverted, which means when Fannie Mae and Freddie Mac impose certain fees on loans, such as investor loans, the yield curve doesn't make up for the hits the Fannie imposes. So what happens is that's when we have to charge a point possibly, or 1.5 or maybe even 2 points to get you a reasonable rate because the markup, the yield curve markup is out of whack. So example, 3 weeks ago, if I charged somebody 1 point, I could probably get them 3.25. The APR might be 3.4, 3.5, whatever. But now that might be 4.25 or 4.5, or you might have to charge 2 points to get to the low fours. So historically, that still makes it amazing for investment property and second homes, but they've gone up because Fannie and Freddie are sort of like squeezing that funnel a little bit. Now, what I teach at Velocity of Money for a lot of people is how to live in 3 properties in 3 years, all owner occupied. So what I'm talking about for investment property rates doesn't apply to the people with 3, 2, 1 and done or single family fast track. Now, what happens when you look at a 4% interest rate on an investment property versus a 3% interest rate on an investment property? Really doesn't matter. Why? Because we're calculating yield. Yield is your cash flow, right, on your property in conjunction with what you paid down on the property. So maybe it makes the property lose $200 a month cash flow. That if we're making $1,000 a month, it still might have a good yield. Or maybe at some point, if rates go up a bit or continue to go up a bit, it might drop the values a little bit, right? And then so it's all relative to interest rate versus price. So I wouldn't worry too much about it. But if you guys are in the middle of a deal, have a loan with somebody else, and are questioning where that's all coming from, I love giving people free consultations because then they remember me next time, or they remember their son, their daughter, their sister, their cousin, whatever. So now the current market, all the realtors know that there's no lack of inventory. We know that rates are still historically low. I see a tremendous trend coming from a lot of the Northeast and the Midwest to the Floridas, the Georgias, the North Carolinas, right? Because people want more property. Obviously, Manhattan's struggling a little bit. But at the end of the day, people say to me, okay, great. Like, you teach us how to buy 3 properties. Well, I don't think there's good deals out there. And I'm like, well, first of all, there's good deals throughout the country. It might not necessarily be in Hudson County, New Jersey. It might be in Middlesex County, New Jersey. It might be in Mercer County. It might be in Florida. It might be in Nevada. So there are real estate deals. And I also teach people how to hire management companies, what fees they should pay, how the loan should be set up so that they can succeed. 30-year fixed, pay extra to pay it off in 20 or 15 with the tenant's money. All sorts of things like that in the coaching. So, by the way, if you're sitting here saying, wow, this is a ton of information, it is. There'll be more information tomorrow, but also it pales in comparison to what I teach people in my coaching program. My coaching program is a 1-year journey that teaches people how to be a real estate millionaire. Half the problem is when I talk to people, they're like this. Oh, I want to create a REIT. I want to start this fund. I want to buy 20-unit properties. And I said to my friend 2 weeks ago on a call, I said, you realize that from a real estate investor perspective, you're in T-ball right now, and you're looking to do something that's in the big leagues. So what I teach, and my loan officers, my staff, they all understand the products. It seems elementary to us now, but to the public, because everyone sort of has iterations of what they should do in real estate, how they should do real estate. They see DIY shows and what goes on TV. So they make up in their head what a good real estate investment is. Too often people bury money in real estate, more money than they need to. It's not about how much you put down, it's what your cash flow is, right? And too many people have too much equity buried in their primary residence. So at the end of the day, like, our job is, it's kind of like going to the gym. It's kind of like going to the doctor. Like, let's take a look at where your life is. Let's take a look at what you have going on financially. We're never going to make anybody feel bad. But when I do my seminars, I know that people are sort of squirming in the seat because they're like, oh man, like, I want to be that person 20 years down the road that Frank's explaining, but I'm not there yet. And it's not your journey to figure out. It's our job to help you identify where we are today and then create an action plan for where we're going tomorrow. Mechanically speaking, the program is not hard, right? It's understanding the concepts, it's understanding the formula, and then it's understanding how to analyze the properties so that you know what's a good deal and what's a bad deal. Once you get that down to a science, you're ready for the big leagues. You're ready for the NFL. And it doesn't necessarily mean you have to have 30 units. You could have 3 units and retire very, very comfortably. So the last thing is buying power. Every 100 grand you spend, right, is, worth about a point on an interest rate. What I mean by that is, if you were going to go borrow $400,000 at a 3% interest rate, in comparison, if the interest rate was $400,000, it's actually not 100 grand. If the interest rate was 4%, you could borrow about $330 if it was very close on what they call a debt to income ratio. So, it's funny because some people who maybe are just getting started and aren't making a lot of money, we have to squeeze every dime out of what we can get them approved for. We often pay off, ask them to pay off credit cards, and hey, you only have 3 months left on your car loan. Why don't you pay that off to get it in line with getting the mortgage approved? And then other people can afford a lot more than they want to afford. So one of the things I talk to people about when they're first-time homebuyers is tax deductibility. Renters don't really understand tax deductibility. I'm not going to explain it now because we're better off on a whiteboard, but just as a little brief version of it. With all things being equal, if people are in a 35% tax bracket and they go get a mortgage, and the mortgage and the interest is $20,000 a year, you're getting back from the IRS $4,000 to $6,000 at the end of the year after you file. So what happens is a renter will be like, "Oh, I don't want to pay $2,000 a month. That's what I'm paying now." And I'm like, "All right, well, I get it, but you have $2,500 a month really to work with because you're going to get back money at the end of the year. Now you have to be able to pay your first 12 or 15 mortgage payments, but obviously that goes into budgeting and other things that we talk about." So that's one. Two is that does not include the amortization, right? The paying off of the loan. So if you borrow $400,000 in the first year, it's somewhere around $5,000 that gets paid off the mortgage. So the way mortgage works is on a 30-year fix, it's mostly interest and a little bit of principal. And as time goes on, it's less and less interest, more and more principal, and you're chunking away more over time. Now, that's why I show people, especially with investment properties, how just $250, $300, $350, $400 a month, depending on how much you borrow, by paying that extra, pays off the loan in like 10 years sooner. So 10 years sooner when you pay off the loan is monstrous. Why? Because if you have a $2,500 payment times 10 years, you have to subtract out the taxes. But say it's $2,000 of principal and interest, or $1,800 in principal and interest, times 120 months, it's a ton of money. It's always over 100, 130,000 of payments that you don't have, that you don't have by following my strategy. So to recap, mindset, doesn't matter where you are today. Interest rates are great. Credit is habits. We can help you with that. It goes back to budget, right? If you're a realtor, this is not a recap, this is a quick thing. Part of the university is that I'm certifying realtors to be trained by me so that my coaching students come out fired up and the realtor can speak the same language, okay? The interest rates are going to be good. They're just not as good as they were, okay? Coaching will change your life. We're so excited. We're nationally, we're engaging in a national audience now, month over month. The third week of the month at noon on Thursday is always our realtor call, because we want to educate, we want to incubate, we want to help new and existing realtors do more business by helping me educate buyers why they want 3 properties. The fourth Thursday of every month, which is tomorrow at noon, we do our buyer education and our client training. And if somebody's really fired up about being a real estate millionaire, by joining the coaching, we're going to get them there. Okay, so thanks for your time. Love all of you. Thanks for listening. Any questions, hit me up at, velocityofmoney@eventbrite.com. But the email, by the way, is hello@thevelocityofmoney.com. If you just have a quick question about a loan estimate, you have a quick question about what you can afford, we pre-approve people same day. So the same day you give us an application, my team is pre-approving you. We're telling you what you can afford. We're inviting you to engage in the strategies that I teach, which is that we all need 3 pieces of real estate. So thanks, everybody. God bless. Have a wonderful Wednesday, and I'll talk to y'all soon.